Good afternoon, and welcome to the Booth Management Conference session on lessons from the pandemic. My name is Stephen Davis. I'm joined by three of my outstanding booth colleagues, Marianne, Bertrand, Pascal, Noel, and Chad Syverson. All three have conducted extensive research on the economic and social consequences of the pandemic and policy responses to the pandemic. We will tap into their analysis, evidence, and insight in today's discussion. As you know, COVID-19 has killed millions of people around the world, including more than 500,000 in the United States. The pandemic has disrupted our lives in many ways, large and small. It triggered an extraordinary collapse in economic activity. Currently, the US economy appears to be on a trajectory of rapid growth, but the outlook remains unusually uncertain. And while the situation has improved in the United States, it has worsened in many other parts of the world. As a headline in today's Wall Street Journal warns us, India's COVID crisis could reach you too. So we're not out of the woods yet by any means, but we've been in the woods for 15 months. And it's a good time to ask what we've learned to date. My colleagues are well positioned to provide some insight into what we've learned. So Marianne, let me start with you. You've studied the impact of the coronavirus on small business. And I wonder if you can just summarize some of the most important lessons you draw from your research, and maybe you want to tell us how you conducted your research as well. Please go ahead.
Yeah, thanks for the introduction, Steve. So I think it's, in terms of like how the research happened, I would go back to last year, spring break, and the last day, we were on campus, went back home, realized that, kind of the world was just falling apart around us. And I think many of us, kind of Chad, Pascal, but many other economists kind of really got to the moment, like, what can we do? What are the things that we can do at this moment in time? March 15 or 16 was really that day. I remember that spring break having conversation with MBA students that were concerned about small businesses and trying to figure out ways to, try to support them, anticipating what was coming ahead. And then, kind of move from like these kind of conversation with MBA students to try to figure out, as a researcher, is there anything that I can do to, to contribute to the moment? And, that turned into a lot of research, kind of, I often talk about big R and little r research. I barely do any big R research. A lot of this ended up being kind of more little r research in terms of its, intellectual kind of depths, but, research that, I think many of us thought would be useful to, to guide policymakers as they were struggling through what to do. So one of the things that we did, very early on, kind of the last week of March, is a survey of very small businesses, very convenient survey. So I think a lot of us kind of cut corners, kind of during COVID, trying to get as much data as quickly as possible. So we did a survey of small businesses throughout the US, just to try to understand, kind of how much they had already been impacted by the crisis, but also to try to get an understanding of how much of how much financial kind of resources they had internally, kind of to address the crisis, absent any kind of outside support from the government. And what came out of that was, maybe not surprisingly, that a lot of these small businesses were looking at probably 2 weeks of cash on hand, and absent an immediate response given the closures, many of them would be very much unable to keep on going. It was striking, kind of like, talking to these small businesses, that they wanted any kind of assistance. They wanted grant, but they're also very open to get, access to loan to be able to stay afloat. So that work, kind of was, I think important again in trying, and many of us have done this, to try to provide data to inform governments about, kind of the scale of the support they would have to provide to the act of Congress that followed. Another thing that we did is to try to measure as real time as possible what was the extent of the business closures and the changes in employment. And this was kind of a moment where we partnered with a company that's called Homebase, that has access to real-time data for a very large number of small businesses throughout the US. So it's a company that partners mainly with restaurants and retail. So it's definitely not representative of the US economy, but it's very representative of the sectors that we knew to be the most impacted. This partnership kind of led us to be able to track literally on a day-by-day basis, but we release this information kind of more on a weekly basis, a sense of like how many businesses had shut down, had kind of reduced their hours, kind of tracking really kind of the recession up until today. We are still kind of looking at these numbers. This data again was special. It was convenient. Yet again, it's not the kind of representative data that we are used to to working with, but was extremely timely because the CPS data comes with a month's delay, and as Congress was deciding what do we need to do, what is the extent of the crisis, this was the kind of data that kind of policymakers could be relying on. Now, on just I think I'm just trying to stress the convenience of what we were trying to do in terms of the big lessons that that we have learned. I'll just draw a few things, thinking mainly about the work that we have done with Homebase. I think obviously, not surprisingly, the shock was extremely rapid. It kind of all unfolded in in a couple of weeks. To me, that stresses the lack of preparation that we have in the US to address kind of crises that are that sharp. Lots of people kind of lost jobs and faced weeks of uncertainty as to what kind of support they would get from expansion of the UI system or support to the businesses. So to me, kind of preparing better for this kind of crisis require putting in place some more automatic stabilizers that would not let so many people kind of rely on Congress kind of getting their act together. The other final thing I'll say, and I know I'm getting probably too long, is this crisis clearly was very different from the prior one, is that it was very much focused on, service sector and retail, unlike prior recessions that have been much more focused on, on the manufacturing part of the economy. We know that there are long-lasting impact of recessions for people that lose their job. One of the questions that is interesting to me is whether these recessions will be as long-lasting, in the sense that the people that hold the jobs in the sectors that were most impacted are already turning over these businesses at a very high frequency. So the extent to which they have firm-specific skills, when we think about the job losses that were happened during this crisis, might be quite different than prior crises. And I think that's a little bit of a silver lining in how lasting the losses will be for workers. I'll stop there.
Thank you. Thank you. We may come back to some of those issues, but let me turn to Pascal. Pascal, you've done a lot of research on the distributional consequences of the pandemic and the government's responses to those distributional consequences, especially as it relates to unemployment benefits, which was obviously a huge part of the overall social safety net that played a role in cushioning job losers. So maybe could you tell us a little bit about your key findings in that regard and what lessons you draw from them?
Yes, thanks a lot. So I think the first key fact to understand actually follows from a lot of the work and the kinds of data that Marianne was describing. And the findings from that are that the types of workers who lost their jobs during the pandemic, especially in the early on in the pandemic, were a particular subset of the population. So because lower income workers tend to work in the types of sectors that have more consumer facing responsibilities, you saw much larger job losses amongst low income workers. Now, what my colleagues and I did is try to understand, well, how did that translate into the sort of financial lives of those workers by looking into transactions that we can see in their bank accounts. And what we actually found is that even though low income workers had the largest labor income losses, they actually had the fastest spending recovery and the fastest increase in their savings. And so at first it's sort of a little bit of a puzzle. So how can it be that the workers who are losing jobs are the ones that eventually are actually seeing their spending recover the most and their savings recover the fastest? And when we dug into it, it turns out that a big part of the reason for that is because of the very large government response. And for workers, it primarily had two pieces. One was these large stimulus checks, these tax rebate checks. And then the second was a large expansion of unemployment insurance, which is one of the things you asked about. So in terms of unemployment insurance, it really was a massive response from the government. So we saw the largest expansion of unemployment insurance in US history. The size of benefits that typical workers were eligible for increased by a factor of 3. And about 3 out of every 4 workers who were receiving benefits actually was receiving more money on unemployment than they were at their prior job. And so this massive expansion sort of raises a couple of questions that we tried to go and answer. The first is, when the government transferred all this money to workers, did it actually support them and increase their spending? And the second is, was there a cost because when workers are earning so much on unemployment that they wouldn't go back to look for new jobs or go back to their old jobs when their companies open back up again? And for the first question, we found that these benefits that were given to workers had large impacts on their spending. And it wasn't obvious because you might have thought at a time when a bunch of the economy is shut down, the types of things that you can spend money on is constrained, that you might have seen a much smaller spending response, but that's not what we see in the data. We saw that when households received these benefits, it really helped them go out and make purchases. And then on the other side, sort of in contrast to these large impacts on spending, we saw very, very small impacts in terms of disincentivizing workers from looking for jobs. So again, you might have expected that when you can make 50% more on unemployment than you were making at your old job, that many workers would try to stay on unemployment as long as they can. That's not what we found at all. We found many, many workers going back to work even when they were eligible for these benefits, and a much smaller disincentive than you would have expected based on pre-pandemic evidence. And so one of the things that we're working on right now is trying to understand, what it was about this economic environment that meant that workers, weren't disincentivized in the way that we might have expected based on prior evidence. It's something that we don't have all the answers yet, but we're still working on it. But I would say sort of the fundamental finding is that the government response was very aggressive, and it was able to cushion many households so that their financial impact was much less than it might otherwise have been. And the government actually was able to do that in a way that didn't have very negative impacts on the economy that you might have been worried about.
Pascal, as I listened to you talk, I wonder, is it also the case that the kinds of goods and services that lower income households purchase, and those are the ones, as you explained, who benefited most from the unemployment benefits and so on, are they more concentrated on the kinds of goods and services that were less affected by the pandemic, both on the social voluntary distancing side and government shutdown orders? Is that part of what's happening there?
So yes, it is. That is a little part of it. Although we looked at sort of the idea of what are the budget shares? What share of your budget is spent on the kinds of goods that are in sectors that are really shut down right now that you can't really go out and spend? And you might have expected, look, higher income workers, maybe they spend more of their money on travel and on restaurants, and those are shut down. And so you're going to see a shrinking of their expenditures, but that's going to be bigger than what you'd expect for low income workers. There is a little bit of a delta. So it is true that the sectors that were shut down are sectors that disproportionately have more spending from high income households and low income households. But that by itself wasn't enough to explain why you saw less of a spending drop for the low income households and a faster rebound for low income households. It really turned out to be a big picture. A big part of it really was the big transfers that they were getting from the government.
Okay, thanks for that, Chad. Let me turn to you, and you've dug deeply into I think why we had such a big economic contraction, and tried to study disentangle the role of what we call voluntary social distancing and versus government orders to shelter in place, stay at home, to shut down non-essential businesses and so on. So tell us how you approached that question and of that set of issues and what you learned.
Sure. So this is work that Austin Goolsbee and I did together, and we looked at that question about, well, do what Marianne was suggesting, put yourself back into mid-March or late March of last year. If you would have looked around, you would have seen a bunch of governments imposing shutdown orders of various types, closing particular kinds of businesses, requiring shelter in place sort of behaviors. You would have seen that, and you would have seen a big decline in people's commercial activity. People weren't going to stores, weren't going to bars and restaurants. If you look at the correlation between those two across jurisdictions, they're really high. So the places that put in shutdowns had the biggest drops in business. And that led to all these debates we've been having and are still having, really, about the effect of shutdown orders and that type on the level of economic activity, and how should we think about that in terms of the trade-off between the economics and the health consequences of these shutdown orders. So Austin and I tried to figure out what the effect of the orders was. And the difficult part of trying to do that is basically these two things were happening at the same time, but of course they're both in response to this pandemic. So it could be that they're correlated, they're a correlated response to the pandemic, but it doesn't mean necessarily that the shutdown orders actually causally reduced the amount of economic activity. Maybe people stayed at home voluntarily because they were worried about getting sick, or both of those are going on and you have to detangle it. So what we did to detangle it is use this detailed data, which is anonymized mobile phone location data. And we can't follow individuals over time. What we have in essence is a counter on the door of businesses. So we know how many people are coming into a particular business's location over the course of a week. So we can count foot traffic at a store, say. We do this for about 2.5 million businesses in the US. And what we did is we compared foot traffic at similar stores within the same metro area, but where one of the counties in the metro area had some sort of shutdown order and another county didn't. And then we compared foot traffic on either side of county border. And we had many hundreds of these kinds of differences that we could look at and pool across to measure what was going on. And what we found was, of the totals peak to trough drop in business traffic in our sample, it was about 60%. So if you average across all different kinds of businesses and all the locations in the US, between the beginning of March and mid-April, businesses experienced a 60% drop in foot traffic. About 7 percentage points of that were from shutdown orders per se. So a little bit more than 10% of the decline in business was because the government was saying, hey, you got to stay at home. Hey, you can't go to these kinds of businesses, or they have limits on how many people can be there at any given moment. So of course, the flip side of that is almost 90% of the reduction in activity was just people staying home because they didn't want to get sick or didn't want to get their family sick. And that, points towards this debate about, okay, do we think about the economy, or do we think about addressing the health effects of the pandemic? And I think the lesson is, well, you don't, it's not that powerful of a lever either way. And one thing we did in particular was we looked at what happened when places came out of these shutdown orders. So they either let them expire, or some places actually shut them off before they were originally set to expire. And you see the same sort of modest effect, but obviously in the opposite direction. So there's about an extra 7 percentage point boost to economic activity when you release a shutdown order. But again, it's not like you magically go back to February 2020 once you release the shutdown order. If the pandemic is still bad in a local area, people are still staying home. And by and large, that's the driver of what's going on. So if you want to boost economic activity, I mean, the thing to do is make people feel safe about going out and engaging in that activity. And doing that to do that means you have to address the pandemic. And we saw some other behaviors I won't go into in detail, but also suggest that this was about risk avoidance. People even within, again, a metro area, the counties that had higher death rates saw bigger declines in business. People went systematically to the smaller, less busy versions of stores. So they went to the small coffee shop around the corner rather than the big chain shop on the busy corner, that sort of thing, when they did go out. So you saw a number of behaviors that sort of aligned with most of what's going on is just people being worried about the pandemic. And the policies were in addition to that, but overall rather modest.
Chad, I wanna- oh, go ahead.
I was
Mary.
just gonna add to this. So I think that even though for sure kind of Chad and Austin have the nicest kind of research design to, to make this point, that it was really about, kind of people being worried about their health rather than just the, the impact of the government shutdown. We, a few other papers in our home-based data as well, but just using the cross-state variation in the lockdown, we came to very much the same conclusion, a very small share, of the decline in businesses due to the lockdowns and, the rest kind of being people being worried. So I think that there's been quite a few studies, I think by now kind of confirming this fact.
So Chad, I want to ask you one question, but then Pascal, while Chad was talking, a bunch of questions came in for you, and I'm going to go back to you in a second and try to summarize those. Chad, in light of your research finding, how do you interpret the fact that the economy recovered substantially between spring and the end of the year, even as the pandemic worsened greatly, at least as measured by testing rates and even death rates? I think by December had come back. How do you square that with the evidence you described? Did people just become somewhat inured to the risks associated with the pandemic and return more to their normal activity, or was there something else?
I don't know if it was as much inured or just I think we understood a little bit better the nuances of the risk and certain things that, people were sort of afraid of everything last March, where it was a little narrower in terms of the behaviors that people thought were particularly risky. So I think the overall response might have declined there. I will say that Austin and I went back, grabbed more of that same data for last fall, when we caught the big wave and some places were reimposing these shutdown orders. We found exactly the same size effects, bizarrely like a 6-7 percentage point effect on traffic of the places or in the places that reimpose shutdown orders. So it seems like, the overall response might be because people thought about, I guess knew more about the risk or the type of risk, and that might have made people a little more comfortable. But in terms of the marginal effect of these policies, they remained about the same size.
Okay, great, thanks. So Pascal, several questions came in. I'm going to hit them briefly. They're on a similar theme. So one question says, many small businesses have had challenges in getting former employees to come back to work. Major reasons. Another question, and I'm going to summarize a bit. A record 34% of all household income now comes from the US government. Growing dependency is driven by increased spending on government programs and declining growth. How do we halt the country from sliding further into dependency? You see the concern there. And then another comment is, or question, you think the massive expansion in public support is now limiting labor supply? So I guess asking not so much about what happened in the past, but now and going forward. And if so, will firms just wait those reluctant workers out, or will they be forced to increase wages to bring them back? So essentially a bunch of questions about labor supply and dependency on the government.
Great. So those are very, I think, interesting and first order questions, and some that we've tried to talk about. Don't have all of the direct answers to every single one, but so let me say a few things. So the first, in terms of, there's anecdotal evidence that small businesses are having a hard time getting workers to come back to work. And one thing that I would say is sort of when we look at the totality of the data, at least through sort of the fall of 2020, that doesn't seem to be a major limiting factor on the macro scale. And what we find is that in normal, one big thing is about firms recalling their old employees. So in normal times, about 1/5 of all workers who are getting unemployment insurance end up going back to their prior job. That was a massive change during the pandemic. So actually, in the summer of 2020, 3 out of every 4 workers who left unemployment insurance were actually going back to their prior job. So it turns out that actually you might have been worried that because the unemployment insurance benefits were so generous, people wouldn't go back to their prior jobs even when their employers came and asked them to. On looking at all of the workers and all the data, that doesn't seem to be a problem. A lot of workers left the unemployment insurance benefits and went back to their prior jobs. Now, why might that be? Well, legally, you can't, if your employer offers you your job back, you have to go back or you give up your unemployment insurance benefits. And so even though these things were so generous, it looks like that rule had bite, and that even if a worker had a private incentive to stay unemployed, keep getting the larger benefits, when their employer called, they realized they were gonna have to give up those benefits, and they went back to work, even if they might not have they might have preferred to stay on the large benefits. And so I agree. I've also seen sort of newspaper articles or some things about some examples of some employees or some employers having trouble getting their workers back, but it looks like overall the entire economy, that doesn't seem to be what was holding back workers, at least through the fall of 2020. Now, looking forward, it's less obvious. We're now seeing the economy pick back up, and you might worry now that if the economy picks back up and we have a lot more labor demand and it's harder to find workers, that you might be more worried about these disincentive effects of large unemployment insurance benefits. But one thing I will note is that sort of government has responded in this direction. And so the numbers that I was saying about how large the expansion of unemployment insurance benefits was, that amount was only available to workers through July of 2020. And then those massive benefits actually lapsed, and you had a little bit of an expansion for a few weeks, and then you were back to the old levels until they re-upped them at the end of 2020, and again in the most recent bill signed by President Biden. And so now you actually are in a situation where most workers are getting about the same from unemployment insurance as they were from their prior employers. And so this worry about workers really wanting to stay on unemployment because they're getting so much more is not really applicable under the current policy regime. And so they did it when we were in a massive pandemic and we were really worried about workers not having funds. And now that the economy is roaring back, the government response has also shifted, and it's less generous in that way.
Great, thank you. Marianne, I want to go back to you and tap into another line of research that you've conducted. And this one's really about trust and the role that that's played in the pandemic. And we had a few questions from the audience before the kind of advanced questions before the session got started on this in this area. So as I understand it, and correct me if I'm wrong, you find in your research that trust in healthcare professionals and the scientific community fell substantially during the coronavirus pandemic. And if that's correct, why do you think that happened? And was it warranted to some extent? And I presume you think it's a concern. And if so, what's needed to restore trust in healthcare professionals and the scientific community?
Yeah, so can I just start a little more broadly? So the fact that you mentioned comes from a survey of representative sample of US households that we conducted. So it was a panel survey conducted over, I believe, 6 waves. The first 5 being very much concentrated in, kind of April and May of 2020, the last wave right before the presidential election by October. The reason why, kind of we did this work was that we have a lot of literature that suggests that crises, deep crises like the one that we experienced, shape people. They shape people's beliefs, they shape people's preferences. And we were very curious, kind of to be able to document kind of real time following kind of households over, those few months any evidence that, their preferences, their beliefs, their level of trust might be impacted. There were a few things that we were interested in, to the extent that many people were losing their job, to the extent that many people were being exposed to, health, tragedies, losing a family member, losing a friend, were people's views on things like redistribution, kind of support for the unemployed, support for universal health care, were they going to be affected by, by those experiences. So that was kind of the broad goal of the work that we tried to do, and are still really analyzing. So I'm not going to talk about all of the results, but I'll talk about one of the things that was most striking is that we tracked level of trust in a set of, inside of institutions. So one is, Congress, so there was, trust in Congress went down, but, it was already kind of 3 and it went down to 2. So it went down, but it could have done much lower than it, than it started as. The most movement that we saw was about trust in the scientific community, which declined, kind of dramatically over that time period. Again, the last time we have collected this data is October. Things have changed. We have a vaccine and all of that, so it'd be certainly useful to go back. But we saw a massive trust in the scientific community over this point in time. Now, as to what's driving it, I think there's one corollary fact that is worth, mentioning, is that declining trust in scientific institutions was only among Republicans. So if you look at Democrats, there was a small decrease in trust in scientific community over those, that time period. The decline was massive among Republicans. Furthermore, you can, kind of go and dig into not just people's kind of reported political identity, but where they consume their news from. And, kind of, again, this is all descriptive and kind of where the strongest correlation, you really found a deep effect of watching kind of biased, biased news, Fox News in particular, in decreasing the trust in the scientific community. So looking at these facts, it's not like I have a perfect experiment to tell you exactly what happened, but what we seem to find is correlates with probably what we've heard over that time period. I mean, I think there was a lot of discussions over that time period about whether the mask made sense. A lot of things were said about, kind of approaches to deal with the epidemic. And it sounds like, the way this was portrayed in, kind of the right-wing media really impacted, at least, in the interim, level of trust in the scientific community. Is that a scary thing? Yes, I think it is a scary thing, because if we cannot,
Marianne, can I just ask one clarifying question? How do independents fit in? You talked about Republicans.
In between. So whenever I kind of I think about running these regressions, I'm going to make the independent kind of the missing category. Or I'm going to make people that, do not consume MSNBC or Fox, but have a more kind of unbiased media diet, kind of the medium category. So everything is kind of relative to these independent or relative to people that have a more kind of neutral media diet. But yeah, so is it something important, something worth keeping on looking at? Absolutely. I think we're not going to go very far as a country if we cannot agree on on facts and on science. And this was not a good development.
So, but I just want to probe a little bit on one thing. So conditional on someone's political affiliation. Was there any relationship between how bad the pandemic was in their local community or their state and the extent to which there was a loss of trust in the
community? So all of this, that's a good question. And so I think what you can, kind of not surprisingly, if you look at, again, especially the early months of the pandemic, there's no doubt that, Republicans that tend to live more in rural areas were less immediately impacted by, especially the health implications of, of the pandemic, and, kind of related to what Chad discussed, kind of where there was less health risk, there was less economic distortion at the beginning. So they were less impacted economically at the beginning. But everything that I'm describing here is kind of conditioning on, did you lose your job? Did you lose more than 10% of your income? Do you know someone that, kind of was hospitalized because of COVID, or were you hospitalized yourself? So we're trying to kind of net out from this, the economic factors. But that, that raises another point, which is that when I got into this work, my prior was going to be that exposure to these, intense job losses, exposure to deaths would also have shifted people's views on, important policies like universal health care, maybe even UBI and things like that. And we saw very little of that. There's little evidence in the data that directly experiencing the crisis kind of shift people's views and preferences for, the most important policies that we fight on a regular basis in this country.
I see. Okay, great. Thank you. So Pascal, let me go back to you again and tee up another question for you all. Yeah. So let me ask you to broaden the lens a bit, and I think you've already suggested the U.S. response to the pandemic in terms of financial assistance to workers was enormous. I think historically unprecedented in the U.S. context. But it was also quite different from what happened in most other rich countries. Okay, so can you just sketch out that terrain a bit, both in terms of how the U.S. response differed and whether, if you think we can learn anything at this point from these differences across countries in how they approached the financial assistance to workers. And in here, I'm focusing on rich countries for the obvious, not because they're more important, but just because they're more similar to the United States in other respects, aside from the policy response.
Great. So let me first talk about the narrow policy of unemployment insurance, and then talk about more broadly the different kinds of ways of supporting workers, which can be unemployment insurance or can be other kinds of programs. So for unemployment insurance, a few other countries in the OECD expanded the level of benefits just like the US did. But even amongst these countries, the US was a major outlier. So the degree to which benefits were expanded in this country was about 4 or 5 times larger than any other country that expanded benefits during this time period. Now, one thing to point out is that in some ways this was actually a little bit of a mistake, in that if you read the press releases at the time, the policymakers were trying to get such that the average person on unemployment was getting about 100% of their prior earnings. But it turns out that because the distribution of earnings is skewed in the US, that when you sort of do that, it means that most workers are actually going to earn more than they were at their prior job. And so the US was sort of a massive outlier, but at the same time was a little bit of an accident that it was such a massive outlier. And as I mentioned, when they re-upped the program, they made it half as generous. And we're now closer to what more of the other countries are, although still more generous than almost every other OECD country in terms of unemployment insurance benefits. Now, there's also a big difference in terms of what are the programs that were used to support workers. Again, like Marianne described, massive labor market disruptions in the US, that was seen very similarly in many other countries, essentially every other country, including all the developed countries. And a lot of them, instead of focusing on unemployment insurance, they focused more on policies that sort of subsidized workers and workers' salaries to stay at their current jobs. And there's some pros and cons of that approach relative to the US approach, which by and large was supporting workers who, once they lost their job, and giving them large unemployment insurance benefits. So the benefits of doing things like subsidizing employment at your current job is that it reduces the disruption to workers, all right? You keep getting the same paycheck from the same employer. You don't have to go through the hassle of dealing with the websites and signing up for the benefits and waiting for the benefits to start, which was a big challenge in the US when we saw millions of people applying all at the same time. So, essentially the only thing that changes is that for many people, you just don't go to work, but you still get your same wage. Everything else is the same. The cons of that approach of subsidizing workers at their prior jobs is that it may prevent some needed reallocation across the economy. And this ties into some of your own work, Steve, where you pointed out that the pandemic really is a massive reallocation shock. And so at the same time we saw permanent layoffs of many workers, there were other industries, other businesses that were trying to expand and that needed to expand as our economy needs to shift in this new paradigm, and subsidizing workers at their old job that might not be the right jobs in the economy, might not be the most efficient jobs in the economy, might actually make it harder eventually to get the economy back on track and growing again once we emerge from the pandemic. And so I think that's something that remains to be seen in the medium and long term. Was the U.S. response that wasn't trying to preserve matches at existing employers one thing that will enable us to sort of get out of this in a better shape?
I see. Thank you. And I guess it's related to a point Marianne made earlier, that the sectors of the economy that were hit most hard by the pandemic are sectors which historically in the United States in particular have very high turnover rates of workers and of businesses and so on. Maybe accentuating the concern you mentioned about slowing down the necessary reallocation in the economy. Let me Chad, let me go back to you for more wisdom and insight.
Good luck with that.
Okay, I'm gonna ask you a bit of both a backward looking and a forward looking question here, and it has to do with what we're doing right now. We're holding this conference using video meeting technologies, and those technologies have made it feasible. They weren't around 20 years ago, at least not in a very usable form, but they've made it feasible to shift many work and social activities into a virtual mode in response to the health risks and disruptions brought about by the pandemic. So here's the backward looking part of this is, how did these technologies shape the pandemic response? And the forward looking part is, are there lessons here for how companies can prepare for future pandemics or other societal disruptions? It doesn't have to come from a pandemic. So maybe you can speak to both the backward looking part of that and the forward looking part.
Sure. So the backward part, I often think about, like you were saying, what if this happened 20 years ago? And by 20 years ago, I'm trying to do your experiment basically, which is, more or less everything's the same, but we don't have this technology we're using right now. What would be different? And I actually find it pretty plausible that things would have looked very different, that much of the economy would have responded in a different way. I think we had, in some sense, just enough substitution ability with this technology to move a lot of activity in a way that wouldn't have happened 20 years ago. I think, would we have taught classes in person 20 years ago? I bet we would have. I don't think, maybe we would have taken a quarter off. I'm not sure we would have been doing video teaching for a whole academic year. That's just our job, but I think a lot of businesses would have responded similarly. I haven't read a lot about it, but if you read like about the 1957-58 influenza pandemic, it was bad. It wasn't quite the infection fatality rate that COVID has, but it was pretty bad. But it did not have the same sort of disruption to people's location of activity. Let's put it that way. It was just sort of, they had to deal with it. They dealt with it. And as a result, more people died than had they all stayed home and done video conferences if they could have done so then. But the response looked different. And I think that's what's happened here, that we did save a lot of lives because we moved stuff further away because we could. And it's because we had this technology, and the same thing happened 20 years ago, I think in some sense, normal life would have been more normal, but of course the disease would have been worse. So I think, the way I think about it is a lot of quantities changed because of the response, in different ways. And it's because I think we had just enough potential for substitution in how we do things, and a lot of, obviously not every sector, but a lot of sectors. So that's the backward looking part. The forward looking part, what have we learned from this? I mean, the interesting thing here is this crisis made companies try a bunch of stuff they weren't going to try otherwise. And the thing about that is that's costly. I mean, we all paid those costs in our jobs trying to figure out how to do them differently. But it also comes with knowledge. And so you've now got the old way of doing things and the new way of doing things. And you've figured out which one is better for which subcomponent of your work you have to do, and companies the same for the subcomponents of their business. And now we get the pick of the best. And so I'm actually a kind of optimistic about productivity going forward, because I think this, while we paid some costs, I think we learned new and better ways to do some of the things. And I don't think it's going to be radically different, but I think things will be different going forward, and different in a good way. Because if the old way of doing things was better and you just had to make do during the pandemic, fine, you can go back to the old way. But if you figured out a new and better way, you get to keep that. So I think that that's good. In terms of like preparation, you know, I think the way to think about it is kind of like buying insurance. Should companies buy some insurance about future pandemics or other crises? And I guess when we talk about insurance there, we don't really mean the financial product so much as just like optionality in the way you can do things. You have like contingency plans. And I think sometimes a little bit of contingency planning, a little bit of contingency investment can go a long way. You don't need to wire up everything for video conferencing, but if you just know how to use it a little bit, you can make the change very quickly. To use a specific example, I think that going forward, companies are going to be a little more mindful of, okay, what are the scenarios here? And maybe we should just throw a few bucks at this possibility so that we're ready for it if it does come. And I think that will make us a little more robust the next time around.
Yes, you know, I want to pick up on one I think important point you make, is it's closely related to something I've been working on extensively with Nick Bloom and Jose Maria Barrero, and that's this. I mean, the way I think about it is we were forced to undertake a massive economic and social experiment where we tried, both as individuals, as organizations, and as networks of customers, suppliers, and producers, to try out this new technology. And as you said, we have the option to go back to the old technology, the old way of doing things, where we all are in the office or at the workplace 5 days a week, or we can move to something else that involves more remote work. And you know, we've been conducting surveys both of businesses and of workers since May, and what we see is there's a very wide range, say, across workers in their perceived quality of experience with respect to this alternative technology. For some of them, it's about the same as the old technology. For others, it's much worse. But for a substantial share, it's much better. That's to your point about, well, we've learned that there may be a better way to do things. And moreover, what we see in our surveys is that those workers who say things worked out a lot better than they expected are highly correlated with the same set of folks who say their employers plan for them to do a lot more remote work afterwards. So I think it's pretty compelling evidence that's exactly along the lines you suggested. And for the same reasons, I'm also somewhat optimistic that we'll get something of a productivity boost out of this. But at least in our work, most of the productivity boost comes from the savings in commuting time. Okay, you know, if you work 8 hours a day and you normally spend an hour a day commuting, and now you're going to work from home 2 or 3 days a week, you know, that's a pretty big savings. That particular savings won't necessarily show up in standard productivity statistics because they don't directly capture the time savings associated with commuting. So I think there may be productivity benefits, but those productivity benefits may not actually be materialized in the way we measure productivity usually. So there's a bunch more questions that have come in, and I want to put some of them. One,
actually, Steve, before you go, I'm curious in terms of like, can you say more about, you know, kind of, you say there's this big divide among workers that, you know, kind of like it just the same, some like it better. what else do you see in this data? Like what are all the features of workers that are, enjoying the remote environment more than the physical one?
Sure, thanks for that. I'm happy to talk more about it. A few strong patterns that we see. First, it's remarkably pervasive, I would say, across demographic groups, earnings groups, people who differ in their political affiliations, people who differ in their living arrangements in terms of whether they have young kids. Across all those different groups, you see a substantial fraction of people who want to work from home part of the week. There's a minority that wants to work from home 5 days a week, but that's really a minority. So this idea that the desire to work from home is quite pervasive in a mean sense across groups. There's also tremendous differences within all these groups. There's a sizable fraction of people who hate to work from home, and there's a chunk who want to work from home most of the time. Most people are right in the middle. So that's what you see on the kind of the household preferences side. We also ask these workers what their employers tell them they plan for them to do after the pandemic's over. And there's a very interesting pattern that emerges among highly educated, high-income workers, including the people on this panel. Employer plans and worker preferences are quite well aligned for what's going to happen after the pandemic, according to our survey evidence. But as you kind of move down the income spectrum, what you see is that the desires to work from home are pretty uniform, as I mentioned earlier. But the employer plans for people to work from home kind of diminish as you go to lower levels of education and lower levels of income. And so the conclusion that my co-authors and I draw from that is that the benefits of this shift to working from home will be broadly felt across groups in the economy, but very much concentrated on the highly educated, high earning professional classes. So there's a lot of benefits here, but they're going to flow to people who are already doing fairly well.
Thanks, that's fascinating.
So, there's a bunch more questions that have come in, and one big one has to do with something that we've only skirted around the edges of. So I wanted to put that one on the table and see any of you can respond. It says the U.S. also directly subsidized employers to retain employees through the Paycheck Protection Program. Maybe this wasn't as big as the UI supplement, but it was meaningful. Yeah, it was also quite big, that's right. And so here's the question, do you think it was effective or ineffective? So anybody want to bite on that one?
I mean, I can start, but I'm not on top of all of the papers that have been produced. But when we did our first study, looked at home base, looked at the first wave of the PPP program, there was some evidence that, kind of things looked not as bad in terms of, kind of disruption and so much faster recovery in states that access more PPP money. But this was very, very rough. And for, kind of, we certainly didn't have the kind of research designed to go, to go into the details. And it was just the first wave of the PPP money. Well, I think what's very clear about the PPP program is that the targeting of it was, was really, really awful, especially, in the first wave with a lot of businesses that, kind of were not planning to, get rid of any money and didn't need the money, accessing this fund. So, I mean, exposed, it's easy to see, kind of, it's not immediately obvious how much better one could have done it, but clearly, the targeting was very poor. We probably got some benefits out of this, but it cost, must have cost a lot of money. But I'd love to hear what, Pascal and Chad, who may have spent more time on it lately, think.
Pascal, you want to bite on that one?
Sure. So I would say, I haven't looked at this directly in any of the data that I work with. And so what I would say is also just based on reading the literature of the other people who have worked on it, including some of our colleagues here at Booth, Eric Zwick co-authors have a paper on this. And I basically think the conclusion that Marianne said is basically right, in that across these other papers as well, it's finding a similar thing, which is that there probably was some employment impact from it, but that it was very, very costly. And that the cost per job saved was probably much higher than any other typical kinds of programs. And part of it is because it's very difficult to target and to make sure that the money was only going to support workers that otherwise would have been laid off. It's very difficult to do. It may be impossible to do, and we sort of found that out through trying it this way.
Yeah, I think that's, I totally agree with my colleagues. I think almost by design, it's one of those policies that's heavily I'm going to use economistese, but this is a Chicago audience, so we're fine. It's a heavily inframarginal program, even though the desired effect is on the margin. So you're paying for a lot of stuff that wasn't, you weren't going to have to, you weren't worried about in the first place. If you could know where that was, know those companies that were never going to lay off people, you wouldn't give them money, but you can't. It's just like inherent to the way the program was designed. So it becomes very expensive per job saved. The other thing I thought about in terms of the program, and you've already brought this up, Steve, and I know you looked at this in your own work, is this, it reduces churn. And in an emergency, you might want to slow churn, especially if it's ultimately wasteful. But we also know that churn on average tends to allocate resources towards higher value uses. So, are you basically stopping what would be otherwise good movements and resources from companies that aren't effective users of employees and capital to ones who would have? And I think it's going to take some time before we really know the answer to that question, but I think that's a big issue with this kind of policy too.
So let me, I'm basically sympathetic to what the three of you had to say about the Paycheck Protection Program. My reading of the evidence is similar, but let me play devil's advocate a bit, since we seem to have any big proponents of the Paycheck Protection Program on this panel. I think what some of the proponents would say, and they probably acknowledge what we just heard to some extent, is that, look, it's not only important to support workers, but we need to, when there's such a massive shock to the economy, and as Marianne mentioned earlier, many of these small businesses have very limited financial resources. Mm-hmm. You got to think about preserving the, for lack of a better term, the underlying business ecosphere.
Oh, and I very much agree with that. I think I was commenting more on the first wave, and again, I'm not in the details of the waves that I've followed, but I think policies that have been targeted, communities, kind of like more kind of communities with like more minority-owned businesses, kind of like environment where we know that some of these small businesses are really the fabric of society, and if they disappear, these neighborhoods are gonna are really going to suffer for the very long term. I think I'm much more optimistic about what was done at that stage. It's just more the first wave that I have some trouble with.
Okay.
In true professor fashion, I'll now argue with myself. I think that the other side of the policy issue, the productivity effects of the PPP is, one thing firms have is intangible capital, and a lot of that is the product of sunk investments. It's valuable, but you can't sell it on the market. And if companies go bankrupt, you basically lose all that intangible capital. And so there is an argument there that to preserve that intangible, you would want to save that company, particularly through a temporary crisis.
Let me add two things on that. The first is that a lot of the research has tried to think about what impact it had on employment. But actually, sort of to your question, it's probably that the key way to actually judge the program is really about business failures. These are the things, because we had a bunch of other ways to support workers, it may be that really you should be thinking about business failures as whether this was a successful policy or not. And then from a design perspective, a bunch of the money, especially early on, was conditioned on paying workers' salary, and it was actually difficult to spend money on the other things that businesses need to stay viable, things like rent, for example, and utilities, et cetera. And so designing it in a way that helps businesses with those kinds of things that allow them to sort of stay as a going concern and keep that intangible capital is something to learn going forward potentially.
Yeah, and when I talk to economists who were sympathetic to the Paycheck Protection Program and maybe helped design it, I don't think they saw it as mainly an employment protection program. I think that was a political. Treasury Secretary Mnuchin is I think on the record with a comment, I won't get it exactly right, along the lines, we're not going to give money to companies and let them lay off their workers. So I think there's a political challenge in implementing the kind of design that you suggested, Pascal. So we got other questions, and let me try to pick a few. There's a lot of good ones. We aren't going to have time to hit all of them. So here's a big one. I think that's on the minds of many. During the pandemic, many city dwellers moved out to the suburbs. And do you see them moving back into the city? Chad, I know you want to say something. Go ahead.
Yeah, my reluctance reflects the fact that I haven't, all my research on this is very informal, but actually I've looked at a couple real estate markets in particular. We don't need to mention what cities they are, but making direct comparisons between the suburbs and the central city. And I actually have not seen the obvious patterns that would indicate that there's going to be a giant flow. But you know, what's a giant flow? It took 20 years for the suburbs to empty out the central cities in the 60s, 70s, and early 80s. So, you know, 1 to 2% a year for 20 years will really affect things. So maybe you're just not, it's too small for me to see in the casual checks I'm doing. But, you know, I would say, I don't know, come and ask me in a year. I think we're going to know how many people from the first wave who moved out. Plus, I think we got to be a little conscientious about the folks we know have the means to pick up and move out to our second places or quickly find another place and move. I'm not so sure that the median household in the US is quite as mobile as our social circles. And so I think we are just sampling of people might be oversampling the kind of movement that people are talking about.
Let me say a couple things. You know, we do see some evidence in prices, not quantities, but prices that something significant has shifted in the following sense. And here I'm drawing on work by Nick Bloom and others. He describes this as a donut effect in residential real estate prices and rents. It's not surprising that you see big effects on rents, but so let me focus on prices. You do see in major urban areas a decline in residential real estate prices relative to their surrounding suburban areas. And that is an indication that that's not the same as the quantity shifting, okay? But it does suggest that the market is pointing to a persistent shift in the desires about where people want to work, want to live. So that's one point I would make. The other point, just a conceptual one, and you know, much harder to tease out in the data. I think it's useful to distinguish between marginal cities and inframarginal cities. In that, you know, the cities the really big cities that we're associated with that we think about, like Chicago, San Francisco, Manhattan, and so on, it seems unlikely that they're going to hollow out because they were before the pandemic such high income, high wealth, high value, high productive places. So they may become less attractive, and so their real estate prices may fall both commercially and residentially. I expect that to happen, possibly in a big way. But then there are other cities that were more on the margin, and they were. I worry that some cities that weren't doing very well before the pandemic may enter into a negative slide where real estate values fall. So the property tax base falls, local sales tax diminishes, local resources to provide both privately supplied and publicly supplied local public goods, even things like safety and security from the police, how often the streets get cleaned and so on, those things deteriorate. And you can imagine how there's a downward spiral. we've seen that happen in other cities in the United States, Detroit being an obvious example, but Gary, Indiana, another one not very far from where we are right now. So I think there is a worry of that sort, that some cities that were marginal beforehand and that were scraping by get into a negative downward spiral. And that's partly because they've been hit by a shock, but it also really puts an onus on the local civic leaders, local political leaders, to respond effectively to the shifts that have been brought about by the pandemic. And this goes back to kind of some of Pascal's remarks about, there's a need for reallocation here. There's a bunch of destruction and job loss and business loss associated with the pandemic. And it's important that we get beyond the destruction side and facilitate the creation side. And a lot of that has to do with how well local municipalities and counties and other local government organizations and civic organizations perform. At least that's my view. Maybe some of you want to respond to that.
I think a simple thing to weigh is, why are people living in cities? Is it for production reasons or consumption reasons? I think for the things we've been talking about, production, the onus for agglomeration and production has fallen because of the technology we're using now and people's stated desire to work from home more. So if that's the reason why folks are living in a central city because they just want to have a short commute, then yeah, you would expect all the things we've been talking about.
But even kind of, I think kind of, building on kind of Steve's kind of concern about this, the other reason we live in cities is because of the amenities. And, kind of, I think the other things that we probably have experienced, or I have, is that I can be very, very happy just being at home, watching an endless amount of Netflix series. So I think they might also be really a long lasting impact on like what people want to do with their spare time and the leisure time due to this, which would be another reason not to live in these city centers anymore.
Okay, so more questions, and let me try to choose among them. I'm going to pick one that's a little further afield, and maybe folks won't want to respond, but it's an important question, so let's put it out there. It says, before and during the pandemic, the US government has put the brakes on legal immigration. As US businesses are experiencing labor shortages in many technical and non-technical roles, what should be the new administration's position on immigration? Does anybody want to tackle on that one?
I mean, there are obviously the complexities of what's happening at the southern border. And, but, when I think about immigration, it's obviously much more than that. It's a lot of like high skilled people that, kind of live in Europe, live in India, live, in other parts of Asia. And, it was true before the pandemic, and it remains true very much after the pandemic. The US economy is stronger if we allow, a lot of these people to, to come into our country. So I don't quite see how the pandemic kind of changed anything to what I just said.
On the economic side, maybe it changed things politically. I don't know. We'll see.
Yeah, and in the longer run, hey, who wants Social Security and Medicare when they get older? Raise your hand, because just do the math. We're not having kids.
But it's what I'm saying. Implicit in what you're saying, Chad, I think is targeting a certain kind of immigrants. Those who are going to come and work and contribute to.
Sure, I could come up with a scoring system just based on a lot of things, but yeah, we need more people. We need more people.
Yeah,
and,
I'm on board with that. So I think there's
and just to be clear, I think again, this is not pandemic related, but like all of the evidence that we have is that even when it comes to like lower skilled, kind of lower skilled people, they are interested in coming to this country to work in jobs a lot of natives are not interested in coming and working in. And, kind of, so when I say that, kind of when I started by isolating what's happening at the southern border, it's just because there are numbers and that are a little scary, on that front. But I didn't mean to say that we only want like people with college degrees to come, to come to the US. All the evidence point out that, we want a broader set of people to come to the US.
Yeah, I think that's a widely held view among economists. I think it's one of many areas in which economists have not been particularly successful in persuading much of the populace. I have another question here. So this is kind of more on the themes we've been talking about, and the question starts out with an observation that the pandemic has saved a lot in the way of operating expenses for technology inclined companies. I think more generally for companies that could easily shift to a work from home mode, utilities, refreshment, perks. And it says, what incentives do companies have, those companies that can operate that way, to want to return to the status quo if, as we discussed a little bit earlier, for many companies, for many workers at least, there doesn't seem to be a negative productivity hit associated with that. And just to be clear, and Chad was very clear about this, it is a negative productivity hit for some companies, some firms. So the question is asking, I think, about the set of workers and firms for which you can conduct activities as efficiently as before in a remote mode or a hybrid mode where you're often remote. Why should they return to the old way of doing things? And will they?
Do you want me to give a very Chicago answer?
Yes, that's entirely appropriate.
Quotient bargaining. If people want to stay at home, but the firm makes more money when they put people together, they should be able to work out a deal to get those people to come work together by giving them some of the gains from being together and paying them more than the opportunity cost of coming into work. If they don't, if those gains aren't large enough, then they shouldn't be working together. The company might have preferences to have people in an office, but if it's not making them more money, they're not going to be able to pay the workers their opportunity cost of coming in.
So
Chicago, not for everybody.
Chad's going to open up a new company that says, come here, we'll pay you less, but you can work at home.
Yeah, I think there are companies that do that. They're just not so explicit.
No, in fact, going back to the surveys that I talked about with Nick Bloom and Jose Maria Barrero, we asked people what kind of pay cuts, if any, would they be willing to accept for the opportunity to work from home 2 or 3 days a week. And numbers are pretty big. The average is about 8%.
Okay.
Now exactly how to navigate that and so that it doesn't seem like a slap in the face is, I think, is a tough management challenge. But
what's interesting. Sorry, one thing that I don't have the survey that you have, but like more anecdotes is that for those people, it seems like no one wants to be, a very small group wants to stay at home all the time. People want to be at home like a couple of days a week, but it also seems like people want to be in the office together. They don't want to be coming to the office alone. They want to be those 2 days a week where they'll come and they'll see their colleagues, which, kind of, if true, kind of has clear implications as to how much kind of real estates, companies are going to be able to, to cut under this, kind of part-time, in the office environment.
Yep, I agree. And there's a big challenge there as well on the management side in, making sure the right people are in the office together at the right time, and so that you can benefit from the face-to-face interactions and the socializing that is, part of our work life. Let's see. I think we got maybe time for another question, or maybe I should just see if there's anything else the three of you would like to say in wrapping up.
This was fun. We should do this more often.
Yeah,
it was fun, and it was insightful as I expected it to be.
One thing I will, and touches on it, we had way more data for this crisis than the Great Recession. Real-time, high-quality, granular data, in part because, folks are getting the data themselves, like Marianne and her group, but just the stuff we could look at in short order was so much better than we had 12 and a half years ago. It's just been incredible.
I think that's right. It's part of the big data revolution.
But it was kind of push and pull, right? Because on the one hand, kind of we knew that things were happening very quickly. So there was, unlike, other recessions, with your desire to, get this data. And obviously these data are more available today than they were, 15, 20 years ago.
Okay, well, let's wrap it up on that positive note. I want to thank my colleagues for an excellent, stimulating discussion. Thank the audience. We got a lot of great questions. I apologize if I couldn't get to your question. There were more than we could really accommodate, but I'm glad we were able to take quite a few of them. So thanks everybody, and take care and be well.